Good morning. It's Monday, July 15th. I'm actually recording this video on the Sunday before, so just the day before. Contained in this post on all of our social media platforms is a link to this week's newsletter, which is included here as well. There's a link to subscribe to the newsletter, as I always say every week. I hope you all had a great week and a great weekend. This newsletter from Friday, if you were a subscriber, you would have got it on Friday. So again, I encourage you to subscribe. It's free. You really can't beat the price. The headline to the newsletter is that sharply lower inflation brings Fed rate cuts back into focus. And clearly it was a good week for rates, notwithstanding the little hiccup we had on Friday with PPI. The wholesale measurement of inflation came in materially hotter than expected, but there was a whole bunch of technical issues in there, and the market actually kind of settled out and improved for the day on Friday before the market closed. So again, in this link, you can find a link to the newsletter. I encourage you to subscribe. There's some great insights in this week's newsletter, some great graphs and charts to help explain to your clients what's going on and or your customers. It kind of shows what's happening with the incremental components of CPI that really helped drive rates down this week. For the next week and a half, really, there's not going to be a lot of data. There's going to be some Fed speeches given. Powell, I think, is going to speak today on Monday the 15th. And so there's always a risk in that process. Obviously, we had the shooting of the ex-president, the assassination attempt on this weekend. I don't anticipate that should affect the markets much. If anything, it will likely maybe improve his standing with his own followers. Who knows? This isn't really meant to be a political commentary, so I'm going to stay out of that. The reality is that we've seen a downslide in inflation, and Fed rate cuts are back on the table. The most widely expected time frame is for the next one, or for the first big cut here, is going to be September, for two reasons. One, if they don't do it by September, the Fed runs the risk of being seen as political by getting too close to the election. There's a fairly significant consensus that this rate cut, the first rate cut, could be substantial, maybe as much as 0.75%. I don't know that it's going to move. It won't equate to a 0.75% reduction in rates. In fact, most of the challenge we have in rates today is actually the spread that investors are still getting over the 10-year to mortgage-backed securities. They're still running at almost historic levels, although they have come in some. We actually talked about that in this past Friday's weekly roadmap. So also in this post is a link to the weekly roadmap, and I'll come back to that in a second. In short, this week there's some data. We're going to see retail sales. We're going to see some housing data released. Beyond that, there's not going to be a lot of really major data that's going to move the market. But at the end of next week, the end of the week of the 22nd, on Thursday and Friday, we're going to get a jobs report that will be substantial. And really the next big data point that we're going to look for is going to be the CPI data for July. If we continue to see either improvement or materially lower inflation, then in my view, you're going to lock in the likelihood of a Fed rate cut in September. And there's a debate now, maybe 50-50, between whether we get two more after September, after the election, whether we get one in November and December, or just one at the end of the year. But if they do September, you're not going to see another one until after the election, no doubt, because the Fed's not going to want to be seen as putting their thumb on the scale of the election. The reality is that in 2 weeks, as I mentioned, we're going to see the jobs report. That'll be an important one. And this coming week, we're going to see June retail sales on Tuesday. We're going to see June housing starts and building permits on Wednesday. And we're going to see jobless claims again on Thursday. So not much to report in terms of data this week or to pay attention to. We'll see some data the following week. I do want to mention, back to the weekly roadmap, we have a really exciting guest. We've put 4 of these calls up over the last month. We've essentially done somewhat of a slow a really slow rollout of this to make sure that we get both our process and our technologies down. We really feel like we're there now. I want to repeat, we're offering this call every Friday at 9 a.m. called the Weekly Roadmap. That's really meant to be kind of a sales call for originators, branch managers, or anybody that's in the sales business in the mortgage space. You can go up, it's free. It's going to be free, certainly at least through the balance of July. We want to expose people to this call, and we have an exciting guest this coming Friday. Tiffany Rose, one of the top originators in the industry over the last, 15 or more years. Just recently was with Guild Mortgage, is a 100 million plus producer perennially, has this really fabulous strategy that she refers to as Invincible Lender. And it's really about how to broaden and open up the top of your funnel, the top of your lead funnel, by utilizing social media and skills such as that to help drive additional business over on top of whatever you may have as a referral business today. So I'm excited to have Tiffany on Friday. If you haven't registered for the Weekly Roadmap, I encourage you to do it. I encourage you to go up. The link can be found either here in this post, or if you go up on our website, mortgageap.com, you can find the link to the Weekly Roadmap. I'd encourage you to go on. If you subscribe to the Weekly Roadmap, you automatically get the newsletter for free. If you're uncomfortable doing that, you just want the newsletter, there's a link in this post as well for that. So I encourage you to do that. I hope you all have a great week this week. The reality is we should see lower rates here moving into the second half of this year, and particularly if we have an opportunity to get some additional quality inflation data and a Fed rate move here in September, if not before, if they decide to surprise us before. I would say this, the Fed is clearly pivoting and looking at the unemployment numbers. Unemployment has increased for the last 4 months in a row. That's typically a recession warning. And so the Fed has this dual mandate, not just inflation, which is clearly coming down, but also full employment. And so keep your eye on that data. With that said, I look forward to seeing you again next week, and we'll be sending out some curated data this week, and I'll have some additional posts up during the week as well. My best, and have a great week to everybody.